Okay, good evening, grade 12 accounting learners. I hope you are well wherever you are. I am Mr. N, and I'll be helping you prepare for your accounting final examination papers. We're going to have lessons based on paper 1 and paper 2 topics. I hope you are not going to miss out on any of those lessons. Okay, now for the night, we'll be focusing on the statement of comprehensive income. Okay, now I believe that by now some of you are familiar with the topic that relates to the statement of comprehensive income. It's just a simple topic. It's not that troublesome. Okay, let us begin. So I believe some of you got access to the notes. Okay, so let's start by going through the theories. Thereafter we'll do the practical side of can I ask or maybe like Zoom Yonela Tina, if you can hear me, since we are having large number of learners, the number is currently exceeding 700 there. So if we are to have a lesson on Zoom or on Google Meet, it might shut us down, and there are going to be those learners who are not going to join us because of reaching maximum capacity. Okay. I hope you heard me on that one. So if you have any question, guys, just send through the live chat or over the WhatsApp group chat. I'll be able to reply to you, so don't stress. I hope you can hear me though. Okay, now before we begin, it is very important that you know what is a statement of comprehensive income. It should be income here. Okay, so statement of comprehensive income, or what is traditionally known as the income statement, it is a form of financial statement that is prepared at the end of the financial year to determine the net profit or loss that was made by that particular company, while considering the income and the expenses for the year. Then there are going to be certain things that will form part of the statement of comprehensive income. Now, in the statement of comprehensive income, you have to be careful, learners. We only want the incomes and the expenses for the year. Incomes, it can be the operating income, it can be the interest income, and expenses can be the operating expenses or the interest expenses. We don't want any other item that is not an income or that is not an expense. I believe you now know which item is an income and which item is not an income. Thank you there, Yonela Tina. Okay, now when you prepare the statement of comprehensive income, it is important that you consider the following. Now, first of all, inside the statement of comprehensive income, we only want the incomes and expenses for that particular financial period, meaning that any income and any expense that is not for that particular financial year, you have to know that you have to remove it. You have to subtract it from your incomes and also your expenses. Therefore, we are going to apply the gap principle called the matching principle, meaning that incomes and expenses should match their correct financial year. However, we know that there are going to be certain incomes that are earned but not received, and also certain expenses that are incurred but not yet paid. Now, those ones will form part of the statement of comprehensive income. As long as they belong to that financial year, then they are going to serve as the income and expenses for that particular period. Okay, then you have to note that there are going to be certain incomes that are earned but not yet received. Here we are referring to the accrued income. So we are saying that they should be recorded because they form part of the income for that particular year, even though they were never received. Okay, then again, there are going to be certain expenses that are incurred but not yet paid. Even these ones, we have to add them because they form part of the expense of that particular year. It doesn't matter even though it was never paid, as long as that particular expense has been incurred in that particular year. So it forms part of the operating expense for that particular year. Then again, there are going to be certain incomes that are received but not yet earned, and this will be income received in advance. These ones, we subtract them. The name speaks for itself. We subtract them simply because that particular income is not for the current financial year, it is for the next financial year. So according to matching principle, we only want those incomes and expenses that falls within the financial year. Okay, then again, there are going to be certain expenses that are paid in advance, even though they are not yet incurred, and also them we have to subtract them if maybe there is a certain expense that is paid that is for the next financial year. We have to subtract it simply because it does not fall under the financial year. Can you give an example of an item that won't appear here? Okay, if maybe they are saying that the rent income was received for 13 months, we know that our financial year, it has 12 months. So the one that was received, that is for the next financial year, when we prepare our statement of comprehensive income, we have to subtract it because that income is not yet earned. In the income statement, we only want those incomes that are earned. The same applies with expenses. We only want those expenses that are incurred. Those ones that are not yet incurred but have been paid, we have to subtract them. I hope it is clear there. So don't worry, I'm going to show you the structure and how you deal with income that has been received in advance, and also the expense that are paid in advance, what we call the prepaid expense. Okay, now when you prepare the statement of comprehensive income again, you have to take note of the accruals and deferrals, and also know how you are going to treat each one of them if you come across an adjustment that speaks about income received in advance or prepaid expense. Okay, now let's start with the accrued income. Like I said earlier, accrued income, it simply means that this is an income that has been earned but not yet received. So the fact that that particular income has been earned, even though it was never received, it means that it falls within the financial year. So it doesn't matter when we will receive it, but then the fact that that particular income has been earned, then it serves part of the comprehensive income for the year. Then the same applies with accrued expense. Accrued expense, it is an expense that has been incurred but not yet paid. So the same description that applies with the income, it applies with the accrued expense as well. So accrued incomes and accrued expenses, we treat them the same way. So when we prepare the statement of comprehensive income, if we come across any adjustment that tells us that there is an expense that has been incurred but not yet paid, or an income that has been earned but not yet received, then we just add them simply because they form part of that particular financial year, irregardless of them being received or paid. It doesn't matter. Then in terms of the income received in advance, income received in advance is just the income that has been received but not yet earned. Then this means that we receive the amount, or maybe for a certain rent, then we receive the rent for the next financial year. Now that rent, since it does not fall within the financial year, then when we prepare the statement of comprehensive income, we have to remove it simply because it is not the income for this particular period. The same applies with the prepaid expense. So the income received in advance and also the prepaid expense, we just subtract them if we come across any adjustment that speaks about them. Okay, then let's talk about the simple basic steps that you should follow when you prepare the statement of comprehensive income. Now, these steps, they are very, very simple, because if you follow them without adding or subtracting, you might get yourself some marks. So first of all, you will be writing the item that will be adjusting at that time, whether it's an income or an expense. Then the first step that you do is that you are going to open the bracket. By opening the bracket, it means that you are going to show calculations so that you can earn some part marks. Then the second step, it will be for you to plug or record the amount from the trial balance. If your statement of comprehensive income, you are starting with the sales, then you are having the sales amount from the trial balance, you should take that amount exactly as it is, then you plug it to show that you are calculating or you are adjusting it. Then the third step will be for you to check if there is any information or adjustment that affects the item that you want to adjust at that time. If maybe it's sales, it means that you'll be looking for what? You'll be looking for the credit sales that were never recorded, the discount, not the discount, but then in terms of discount, it can be the trade discount that was never subtracted from certain invoices, and also what? And also the returns by debtors that were never recorded. So you have to look for such adjustments. Okay, then let's go through. These are the keywords, and I've also showed you how you can treat them. Treat them means that you'll be adding or subtracting. Okay, now if you come across any information or any adjustments that indicate that the expense was never recorded, all you have to do is to simply edit. So there is no need for you to just wander around and ask yourself how you are going to treat it. The answer is simple. If you come across any expense that was never recorded, when we deal with the statement of comprehensive income, simply edit, put a positive sign or a plus sign. Then now, what about the incomes that were not recorded? The same applies with the incomes that were not recorded. So even here, you are going to put a plus sign, you are going to edit. Then what about the expense or the incomes that are outstanding or that are due? This one, it means that it will be an accrued expense or an accrued income, and we know that accrued income, since they form part of the financial year, then the answer is simple. Even here we have to edit. So someone asked how do we treat trading stock. So trading stock, we are going to look at the one that was either a deficit or a surplus. Then we can also look for maybe if there is any trading stock that was damaged or that was stolen, and if maybe it was damaged or stolen, then it can be an expense. Then if it's trading stock deficit, then it is an expense as well. Then if we are having trading stock surplus, then it is an income. But then in terms of trading stock, you have to check if maybe there was any insurance claim, because the amount of money that will be claiming from the insurance will be offset from the amount of stock that was the value of the stock that was damaged or that was lost or stolen at that time. I hope you are answered there. Is it Edward? Okay, don't worry about that. When we come across it, you'll be able to see how we deal with trading stock. Then let's talk about the expenses that were just incurred but not yet paid. So this one, it applies the same as the outstanding or due. It means that we have to edit then even with the incomes that are earned but not yet received. So even this one we have to edit. So here the first ones we are adding. Then what about the incomes that are received in advance? Remember, the incomes that are received in advance, it is that income that is for the next financial year. So this one, the answer is simple. You simply subtract it. It does not form part of the incomes for that particular year. Now the same applies with the expense that are paid in advance. You would come across the insurance adjustment indicating that insurance has been paid in advance. Now if you come across such, then know that you have to subtract it. Then what about the invoice issued but not yet recorded? Very, very interesting. If maybe we are issuing an invoice but then it was never recorded, it means that the business made a credit sale on their trading stock. Now this means that this was never recorded in the sales. It was never recorded. So what you are going to do, you are going to add in the sales, then we are going to add even in the cost of sales, then you are going to subtract what you are going to subtract from the trading stock, because we know that each time you sell goods, then sales increase, cost of sales increase, but trading stock decrease. But then be careful, if maybe they are talking about the invoice issued, then obviously even the debtors control is going to increase. Then the amount you are going to use it to adjust for the provision for bad debts. Then what about the credit note, or means that it was never, so say credit sales means it was never recorded. No. Credit sales means that the business sold trading stock on credit, meaning that the time they were selling those goods, cash was never received at the point of sale. However, what we did is that a debtors control was recognized, and debtors control is an asset, meaning that that person, whoever bought from us on credit, will now have an obligation to pay us back the money. Such as, for example, if you go and buy something from Rage on credit, then it means that you are going to owe Rage money. The same applies if any debtor buys from us. It means that that particular debtor will now owe us money there. I hope you are answered there, Michael N. Credit sales never recorded, it will depend. If the adjustment says it was never recorded, then what you are going to do, you increase sales, you increase cost of sales, but then you are going to decrease what? Trading stock. But don't forget to also adjust your debtors control, because each time we sell on credit, debtors control will increase. Debtors control, it is an asset, by the way. Then I hope you answered there, Michael. Then what about the credit note? Credit note simply means that goods were returned, to put it in a simple manner. But then we also know that, let me not talk about that one. If maybe a debtor returns unwanted goods, then it means that we are going to issue out a credit note. Now, if a credit note was never recorded, how are we going to record this one? So this one, we're going to treat it as if it's the debtor's allowance under sales, because it is indeed debtor's allowance, meaning that we are first going to subtract from what? We are going to subtract from the sales, then we're also going to subtract from the cost of sales. But then since those goods are returning back to the business, it means those goods must be replaced back to the storeroom, meaning that trading stock is going to increase. But then what will happen to debtors control? Debtors control will decrease because the amount of money that was owed by the debtor for those goods returned will be reversed. Okay, okay, sorry about your Sotho. Okay, sorry there. Guys, let's use English, ne? Let's use English so that we don't confuse others. Don't worry, the lesson will be recorded. You'll find it there when we are done. Okay, then let's go to the structure now. Okay, so this is the structure or the format of your statement of comprehensive income, and you should know this one by heart. So don't try and rob the system, think that you'd cram, because if you cram, you are going to record depreciation under incomes. So don't do that. Okay, now we are going to start with sales. First of all, remember the first step was to open the bracket. Then the second step was to plug the amount. To plug the amount means that you're going to refer to the trial balance that is given. Then you're going to look under the nominal account section. Then you're going to take the amount from sales. Then you're going to plug it here. Then next up, if you see that there is debtors allowance from yours below your nominal account section, then you have to subtract it, because debtors allowance decrease our sales. Then again, if maybe there is any adjustment that increase or decrease sales, such as credit sales that was never recorded, this one it increase our sales. But a credit invoice that was issued, not credit invoice but then a credit note that was issued, or a return that was never recorded, then this one will decrease our sales. Now the same process applies with the cost of sales. We are going to open the bracket. Then after opening the bracket, we plug the amount exactly as it is, unless if it is not given. If it is not given, look for the markup and also other information that will help you to calculate your cost of sales. Then again, you would adjust it. Now the cost of sales amount, it can be adjusted up or it can be adjusted down. Okay, then we know that if you take your sales and you subtract your cost of sales, obviously you are going to have what? Obviously you are going to have the gross profit. Gross profit, the formula is simple. You take the sales and you subtract cost of sales. There are some of you who are still unable to calculate gross profit. If here the amount is 10, then here the amount is 5. We know that your cost of sales, it should be in brackets in order to find the gross profit. It means that we're going to say sales minus or subtract cost of sales, then we're going to get the gross profit. So it will be 10 minus 5, then that gives us a gross profit of 5. So this one, all of you should be able to do this one, even though you've adjusted wrong amounts, but then the fact that you followed the procedure whereby you took the sales, then you subtracted the cost of sales, then that will give you the gross profit. Okay, please re-say what we implement on the credit sales. So in terms of the credit sales, let me go back. In terms of the credit sales, I said that if the credit sales it was never recorded, is the same as the invoice issued but never recorded. So it means that sales is going to increase, then debtors control will also increase, cost of sales will increase, but trading stock will do what? Will decrease. I hope you are answered there, Yone Latina. This one it's a simple one. Then let's talk about the other operating incomes. Now under the other operating incomes, you're going to come across different incomes, but then it's very important that you are able to identify which one is an income and which one is not an income. Now if maybe you are given 3 columns, they're giving you the accounts, they're giving you the debit and the credit sides. The credit sides. Our incomes will appear on the credit side, but then be careful. Under operating incomes, we only want the operating incomes. We want the likes of rent income, the likes of commission income, the discount received, bad debts recovered, trading stock surplus, the provision for bad debts that has decreased, and also the insurance claim amount. Okay, someone is saying, can you show us how to calculate rent income if it was received for 30 months and decreased by say and was from January? Okay, since you did a request, let me show you. So first of all, you have to identify the number of months. The number of months that would apply the 100%, and also the number of months that will apply the percentage after the increase or the decrease. So the easiest way is by drawing a timeline. If you draw a timeline, it will be easier for you. You mentioned that it's for 13 months, meaning that from, let's assume that you are saying it decreased and the decrease was from January. So let's assume that the year it ended on 28 February. So let's assume that 28 February its year end and it was received for 30 months. Then the 13th month will be March, meaning that since March does not form part of the financial year, already we know that we're going to subtract it. Then it means that from the 1st of March of the previous financial year, or the start of the financial year, then we're going to say, let's say 1st of March 2022, then we're going to say 28 February 2023. It should be like this. Okay, then it means that from 1st of March up until December, because you indicated that the decrease was from January, then it means that from the 1st of March up until December, let me change the color, each month will be represented by a certain percentage before the decrease, meaning that for March, April, May, June, July, August, September, October, November, December. How many months? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Meaning that 10 months before the increase, each month will be 100%. So if you want to know the total percentage of those months, it will be 10 months multiplied by 100%. Then since it is the percentage before the decrease, then the total percentage for those 10 months will be 1000. But then it means that from January up until March, each percentage, each month will be represented by a percentage that is lower than 100%, meaning that if we take the 100%, then we subtract the 5%. That means that after the decrease, each month it will be 95%, meaning that for January it will be 95, for February it will be 95, then for March it will be 95 as well, meaning that you are going to say 95 multiplied by 3, then you are going to add those percentages together. So 95 multiplied by 3, then it means that from here up until here it gives us 285%. Then what you are going to do, it will depend on the amount given. If the amount given it says the total rent for 30 months, then it means that you have to add everything together here. So just that I'm out of space here, let me just do it here. So you're going to say the 1000, then you're going to multiply that by how much? By the 285%, then that'll give you how much? 1285. Let's assume that just that I don't want us to give it the comma, then the formula to calculate the one that does not form part of the financial will be the trial balance amount, then we're going to multiply by x. X will be the monthly rent that you want. If maybe it's for 2 months, if maybe it's for 1 month, you just put the percentage that is represented by that particular month. So the total percentage will be 1255. So if maybe we want to find what we want to find the percentage of 1 month, we want to find the monthly rent that does not form part of the financial year, which is March, then it means here we're going to put the 95%. But then if it was 14 months, then you would say 95 multiplied by 2. So that's how we do the one of the increase. Don't worry about that, I'm going to show you how we do it. I also have certain activities that we can use to deal with rent, so that we can see how we are going to do it. Then let's talk about the gross operating income. Now, to find your gross operating income, you are going to take your gross profit, then you are going to add it with your operating incomes, then that will give you your gross operating income. So let's assume that here it's 2, then it means that 5 plus 2, that will give us 7. Okay, someone is saying, say, we still be able to, yes, you'll be able to watch it. You'll be able to watch it. Just that when you have questions, just drop them. You can either come to my inbox, or you can just drop them in the group. Just that there are going to be certain parents who complain about excessive messages, so we don't want that. Okay, then let's talk about the operating expenses. So under operating expenses, we're going to have the salaries and wages. We know these ones, they are separate from the director's fees. Then the procedure is simple. We are going to consider the gross salaries and wages. We don't want the net here. So if you are given the net and the deductions and also the contributions, just add everything up. What do we record under bad debts recovered? Bad debts recovered, we only record when we receive cash from a debtor that was previously written off. For example, if today I write you off as a bad debtor, then in the future, maybe after 3 months, you come back and pay me that amount of money you owed me that I considered bad debts in the past. Then now I can no longer adjust my debtors control, but then what I can say, I can treat you as in bad debts recovered, because I have recovered the amount that I previously lost due to credit losses or bad debts. I hope you answered the Sipho zonke. Then as I was saying, under salaries and wages, you have to, if maybe you are given the net, then the net salary or the net wage, then you are also given the deductions and you are also given the contribution. Just take everything and add it up all together, then come and add it under the salaries and wages. If maybe they are doing what, they are combining them with the contributions. But then if they are doing the contributions aside, here you'll add the gross, then here you'll add that particular contribution. So in most cases, they like to bring information that says that salary or wage of a certain employee was omitted from a journal. Now, if we omit a salary from a salaries journal or wages journal, then it means that that particular employee was never paid. Then that will form part of what we can say it's creditors for salaries. Then you're going to add it. Then the water and electricity, the step is simple. You open the bracket, then what you do, you plug the amount from the trial balance, then you adjust whether it's prepaid, whether it's accrued, you'll adjust accordingly. But then if it is prepaid, you subtract. If it's accrued, then you add. Okay. Then let's talk about advertising. Nowadays they are bringing it as if it's a rent. They are talking about percentage increases and stuff, so you are going to treat it the same way as if it's a rent. So don't worry about it, this one. So the first step, we open the bracket, we plug the amount from the trial balance, then we adjust it accordingly. It can either be increased or decreased. Then let's talk about the bad debts. Even here, you are going to open the bracket, you're going to plug the amount from the trial balance, then you are going to do what? You are going to adjust it. So in most cases, each time that we write off a debtor, when we write off a debtor, then it means that bad debts will increase. So each time we write off a debtor as a recoverable, just know that the sign here, it will be a positive. Do not put a negative. Then let's talk about director's fees. So in terms of director's fees, I just want us to have to use this space here for directors fees. Oh, I'm out of space. Oh, there is a space here. So in terms of directors fees, first of all, you have to identify the number of directors, meaning that if maybe you are having 5 directors, then each director you are going to assign a letter of the alphabet. Then it will be A, B, C, D, E. Then now you are going to look at the number of months that those directors have worked for, then and those who were paid for. If maybe director A worked for 12 months and was paid for 12 months, then you are going to put 12. Then if director B is 12 months, then you are going to apply the same up until you arrive to director D and E. Then you check how many months they were paid for. Then if maybe these ones they were paid for 10 months each, then it means that the total amount that would appear on the trial balance will be represented by the number of months here, meaning that if you want to find the monthly directors fees, you can just add up all the months together. So here it will be 12 plus 12, 24, then plus 10, 34, then plus 10, 44. So here it will be 44. If maybe they gave you 44,000 as the amount for directors fees, then you say the 44,000 you divide by the 44, then that will give you the monthly directors fee. So 44,000 we divide by 44 months, then that gives us 1,000. Then now you'll decide how many months are owed or how many months were paid in advance. So I still have to show you how we do this one. Okay, so how do we record the insurance claim? So to do the insurance claim, this will be the amount of money that will be claimed. If maybe they say 10% of that will be covered by the insurance, let's say the damage of stock, let's assume that the damage of stock was 10,000, then we're only told that the insurance will pay 80% of that, meaning that we're going to claim 80% on that. So we're going to say 10,000 multiplied by 80%. That means that 8,000 will be claimed. Then what about the remaining? The remaining, which will be the 20%. 20% will be the loss of stock. So this one will be treated as an expense. This one, it means that it is not going to be recovered. So it means that the 2,000, meaning that 10,000 multiply by 20%, that'll give us how much? That'll give us 2,000, meaning that the 2,000 will be the loss while the 8,000 will be the claims. Now the 8,000 will be treated as an operating income even though it is not yet received from the insurance. Then the 2,000 will be treated as an operating expense. I hope you answered there, Yandisa. Okay, I was here. Then in terms of trading stock deficit, we are going to consider the amount on the trial balance, then we are going to adjust. Remember, each time we sell, trading stock decrease, then each time a debtor returns unwanted goods and that particular adjustment was never recorded, then it means that a trading stock would increase. Then at the end we subtract the trading stock on hand. That particular trading stock on hand that appears under your adjustment, know that here you subtract, you do not add. The same applies with the stationery expense. You subtract the one on hand because here we want the stationery that was used, not the one that was on hand. On hand means that it is still there, it is available, it is not yet used. But then the one that we want here, it is the one that was used, the one that was utilized by the business. Then the same applies with the packing material. Then let's talk about provision for bad debts. When provision for bad debts increase, you have to find the difference between the one that is for the current year and the one from the previous year. If it increased from 1 year to, let me show you. So when you deal with provision for bad debts, just use the following method. Just say year 1 and year 2. If you notice that from year 1 it was 1,000, then in year 2 it's 1,500, it means that it is increased, it has increased. And when it has increased, then it is an expense. Ne? Then if you notice that, let me do the one for decrease. If you notice that from year 1 it was 2000, then to year 2 is the one that we calculated in the current year, then it is 1500. Then it cannot be and what it is a decrease. Then a decrease in provision for bad debts, it is an income. So sometimes they would calculate for you. If they say to, then it means it is the adjusted one. If they say by, then it is the difference between the one from year 1 and the one from year 2. So if they say by, take it as it is. Then if they say to, then calculate the difference. By, it's calculated. To, you have to calculate. Okay, someone said, where do we record profit on sale of an asset? So profit on sale of an asset, thank you for bringing that one up. It is an operating income. So profit on sale of an asset, it falls here. Profit on sale of asset, it belongs here. Then loss will be the expenses. Thank you for bringing that, Charmaine. Okay, then let's look at the part. So we know that after you got the expenses here, don't be lazy, add everything up and confirm your amount so that you get something here. So let's assume that here is 3. Then we want to find the operating profit. The formula for operating profit, it is gross operating income, then we subtract operating expense. So it will be 7 minus 3, and that'll give us 4. You see. Then in terms of the interest income, here we'll be wanting those incomes that are in the form of interest, such as interest on fixed deposit, interest on favorable best, then also the interest on overdue debtors. Even the interest on overdue debtors, it forms part of the interest income. So here you are going to add them all together. Then after add, you're going to get the profit before interest expense. So here let's assume that it's 1, meaning that here it will be 4 plus 1, then that'll give us how much? That'll give us 5. Okay, then after you'll have to adjust what? You'll have to adjust your interest expense. Now interest expense, we want those expenses that are in the form of interest, such as the interest on loan. Here you'll be given the loan statement. You should be able to use the loan statement to find your interest. Now I'm going to show you ways in which you can find the interest on loan using the loan statement. Then also we are going to add the interest that is on the bank overdraft and also the interest on overdue creditors. Then this will form part of the interest expense. Now if you take you find something here, let's assume that it's 2, then it means that to find the profit before tax, this amount is always 100%. Then it means that to find the profit before tax, then we are to take the profit before interest expense, which is 5. Then we subtract what? We subtract the interest expense. So here it will be 5 minus 2, that gives us 3. Then if we want to calculate the income tax, the income tax is always calculated based on the profit before tax. Let's assume that is 30%, and our 30% here it's 2. Then it should be in brackets. Now to find the net profit after tax, the net profit after tax, you take the net profit before tax, then you subtract the income tax, then that'll give you the net profit after tax. So here it will be 3 minus 2, so it will be 1. Then that is your net profit, and this is the amount that you are going to take to what? To the retained income. Okay, so let's talk about the depreciation. Now in terms of depreciation, we are going to have various methods. that we're going to use to calculate depreciation. However, we have to take note of any movement of our fixed assets, because we know that during the year the business can either sell or the business can either buy new additional fixed assets. So we have to take into consideration those particular movements when we calculate the depreciation, and of course not forgetting the 1 rand rule. So I'm going to show you how and when the 1 rand rule will apply. So let's go through the formulas first. Now, if maybe the method of depreciation that is used is the cost method or the straight line method, then the formula that you should use it's simply cost, then you multiply by the rate. So for the formula for this one is just cost multiplied by rate. However, the way in which we are going to calculate it will depend on whether the asset is disposed, which is sold, or the asset is new, meaning that our depreciation will be what we call SAN, meaning that the S will stand for the sold, then the old will stand for the O will stand for the old. This is where you are going to calculate the depreciation of the remaining or the existing fixed asset. Then we'll also calculate the depreciation of the new. So again, you have to consider the number of months the asset was available. For example, if maybe since the year started you had shoes from June, you cannot say that you had your shoes the whole year, because you had your shoes from June, meaning that you have to count from June up until December. Then you can say that no, I had my shoes for how many months? For 7 months. Okay. Now again, even when we dispose a fixed asset, then when we calculate the depreciation, we have to use a timeline to count the number of months the asset was available for in the business, because we know that if an asset is sold during the year, then it means that that particular fixed asset did not spend the rest of the year or the entire year in the business. So you have to count from the beginning of the year up until the date in which that particular fixed asset is disposed. Okay, so the formula, if we are using the cost method, we're going to say cost, then we're going to multiply by rate, then we're going to multiply by x over 12. The x over 12 stands for the number of months the asset was available for. The number of months the asset was available for. Okay. Then now, if a new vehicle was recorded, you have to take note of the movement of the fixed asset. Now they can either be recorded or not recorded. Now if the new vehicle or equipment was recorded, it is important that you first try to separate the cost of at the beginning and also the cost of the one that was disposed. Now if the two are done, and if maybe it was recorded, then we don't have any disposal, then it means the balance that is given to you, it is the balance at the end. So it means you have to subtract the one that was recorded. So if they are telling you that they purchased something and this was recorded, you have to subtract it so that you can separate between the one that was available at the beginning and the one that is new, so that you can calculate the depreciation. Now in terms of this method, if maybe the asset is new, then you are going to count from the date that asset was purchased and it was available for in the business up until the end of the year. So it means that if it was purchased from June, you are going to count from June up until December. So this one is the opposite of the one that is being disposed. Now here, if maybe it's new, it doesn't matter which method of depreciation is used. All we want is for you to calculate the depreciation at cost, regardless of the method that is being used. Therefore the formula will be cost multiplied by rate multiplied by x over 12. Again, the x stands for the number of months the asset was available for in the business. Okay, then let's look at the accumulated, the one whereby we have to subtract the accumulated depreciation. So let's talk about the diminishing balance method or the book value method, meaning that here depreciation will be calculated on what? On the diminishing balance method, or on the carrying value or the book value, meaning that to find the carrying value, we have to take the cost, then we subtract what? We subtract the accumulated depreciation. Even here you have to subtract any new that was recorded, any new fixed asset that was recorded, and also what? And also the what? The one that was disposed if it was not recorded. So here it's very important. Now if it is new, we're going to calculate it at cost regardless of the method that is being used. So when it's new, you apply it as if it's at cost, because we are saying that that particular fixed asset, it's new, it does not yet have accumulated depreciation, so you have to calculate it at cost. Okay, then in terms of old, you first have to, if maybe we are being told that there is a disposal, to find the cost of old, you have to take the cost at the beginning, then you subtract the cost of the disposed, then again you would find what? You'd find the cost of the old or the remaining fixed asset. Then the same thing you would do with the accumulated depreciation, whereby to find the accumulated depreciation of old, you would say the accumulated depreciation at the beginning, then you subtract the accumulated depreciation of disposed asset. Then that'll give you what? The accumulated depreciation of the remaining asset. Then to find the what? To find the depreciation, you would say the cost at the beginning of the remaining asset, then you subtract the accumulated depreciation at the beginning of the remaining asset, then you multiply by the rate. So here it's very important that you separate the depreciation with the depreciations, the cost with the cost. Eggs goes with eggs, bread goes with bread. So don't try to do mix masala here, because you are going to cost yourself some marks. Then if maybe the asset is being sold or disposed, again here the answer is simple. We are going to say the cost of that particular fixed asset, then we're going to subtract the accumulated depreciation at the beginning, then we're going to multiply that by the rate, then we're going to multiply that by the x over 12. The x over 12 stands for the number of months the asset was available for in the business. Okay, so I did the reason why I don't play is because of load shedding. Okay, no, don't worry guys, when the net is back and when load shedding, it's the power is back on your side, then don't stress a lot. Okay, so I want us to go through this one. Yeah, now I'm coming to the R1 method. Okay, now if you guys love singing, then I'm just going to do something for you, then you are going to sing it. Then each time when you calculate depreciation, especially when they are using the cost method, you should be able to identify whether something is happening. So let me not spoil it for you and explain now. So let's talk about the application of the R1 or the R1 rule. When and how does it apply? So you have to take note that the R1 rule will apply in cases where depreciation amount for the year is the same. So the criteria for us to apply the R1 rule is to first check if maybe where the depreciation amount for the year, the one that will be calculating at that time, is the same or more than the carrying value amount of the fixed asset in the beginning of the year. So here, this is very important that after you calculate the depreciation using that cost method, it is very important that you compare you compare the carrying value at the beginning with the depreciation that you've just calculated. Now if you notice that the carrying value at the beginning is the same as the depreciation that you've just calculated, or the depreciation that you've just calculated is greater than the carrying value at the beginning, then depreciation can no longer be that amount, because that means that if we consider that amount you've calculated as a depreciation, our carrying value might end up being negative, and if it's the same, our carrying value might end up being zero. Now as long as that particular asset is still under the control or the ownership of a company, then we have to assign a carrying value of R1 to that particular asset. It cannot be negative and it cannot be zero. Okay, then now you have to test this when the cost method or the straight line method is used. So we're going to test it. Then now that particular song I wanted you to sing is this bullet number 3. So if you sing with me, if you notice that depreciation amount for the year is greater than or equal to the carrying value amount in the beginning of the year, then the actual depreciation amount should be the carrying value at the beginning. Then you subtract what? You subtract the 1 rand. The 1 rand is the residual value. The residual value, it is the value of an asset after it has been fully depreciated. After the asset has outlived or it has exited its useful life, then since we are holding the asset, then we have to assign the carrying value of 1 rand, which is the residual value. Okay, then the 1 rand is the residual value. Then I've explained that a residual value, it is the value of an asset after it has been fully depreciated. When the asset has exceeded useful life, it is held by the business and it should have a carrying value or a book value of 1 rand. Then that is the theory part. So now let's start completing the statement of comprehensive income. I hope you can see. Oh, I didn't add answer book. Okay, I didn't add answer book. Then I'll have to create a new one. Okay, now listen up, learners. It is very important that you try to go through the information first before you can start answering the question or before you can start writing, because you shouldn't rush. Rushing kills, guys. Just go through the information very fast so that you can make sense out of it, because after you've read the information, it will be easier for you to know where you're going to find certain information. So we are given information that relates to Shanks Ltd. We are being told that, let me zoom up. We are being told that the information below relates to Shanks Ltd, a listed company, meaning that this is a public company. They are selling their shares or they are issuing their shares to the public through JSE. Then we're being told that their financial year, it ended on the 1st of December 2023. Now, since we are being told that their financial year is ending on the 1st December 2023, it means that any income and any expense that is paid or received that does not fall within our financial year, then we have to subtract it. So when you do the timeline, always put 31st of December on the last end. Any item that falls within that the financial year, we add it, but any item that falls outside the financial year, we have to subtract it. Now those ones who are using their phone, just try to make your phone on a landscape mode, ne? Just do the landscape mode and also change the quality of the video, because it might be blurry on your side. Okay, then we are being told that they apply markup of 60% on cost. Now you cannot be given information for the sake of that. It means that one way or another we are going to use this markup. Okay, then we're being told that the business uses perpetual inventory system, meaning that for every sale they're going to account for cost of sales. Again, we're being told that the FIFO method or the first in and first out method is used to value their inventory on hand. Okay, then we're being told to complete the statement of comprehensive income for the year ended 31st December 2023. Now, if you check here, we are given the pre-adjustment trial balance on the 1st of December 2023. We are given the land and buildings, we are given vehicles, we are given equipment, and also their accumulated depreciations. Now you have to note that if they are saying the pre-adjustment, it means that they did not consider certain adjustment, the likes of depreciation. Now when it comes to the accumulated depreciations, it means that these are the accumulated depreciations at the beginning of the year or at the start of the year. Then we are given the fixed deposit at Medbank at 12% per annum. So the fixed deposit along with their interest on fixed deposit, we can use it to find the interest income for the year. Then we are also given the loan at Star Bank. Then we are not given the interest, but we are given 370,000 interesting. Then we are given debtors control 110,000. We can use this to find the provision for bad debts. Then we are being told that the provision for bad debts it's 5,600. So the one that is given to you here is the one that is from the previous financial year. So we have to compare it with the one for this year so that we can determine whether it has increased or decreased. Then we have sales. We know that under the nominal account section or the statement of comprehensive income section, everything that falls in this section, we're going to use it when we prepare the statement of comprehensive income. Then we have sales. We have cost of sales, which is a question mark. It means that we have to find a way to determine it. Then we have debtors allowances. You remember when we prepare the statement of comprehensive income, we start with sales, we open the bracket, we plug the amount, then we subtract the debtors allowance. Then now we can refer to adjustments. Then we are having the rent income. Okay, then we have bad debts recovered. These ones are incomes. We have consumable stores. Now consumable stores, we are going to check if there is any information. If we are being told that consumable stores, the one that is remaining is 1, 2, 3, then we can just subtract that one to find the one that was used. Then if they tell us that the one that was used is 1, 2, 3, then we are going to use that one. But now if they are silent about it, then it means that we are going to take it as it is, because we are assuming that the one that appears under our nominal account section is the one that was used for the year. Then again, we have directors fees here, we have audit fees, we have advertising, we have water and electricity, we have insurance, we have bank charges, and we also have bad debts, and also what? The interest on fixed deposit. Okay, remember the first step, go through the information before you can actually start writing. You mustn't rush, guys. You must not rush. Okay, then under additional information, the first bullet, we are being told that there is credit sales of 50,000 to debtor El Lufuno on 25th of December 2023. Then we are being told that the cost price of these goods was 37,000. So remember what we said about credit sales. Then we're being told that this was not recorded. Now any credit sales that is not recorded, when we adjust it, we're going to increase sales, we're going to increase cost of sales, we're going to increase debtors control, but we're going to decrease what? We're going to decrease trading stock. Okay, then on bullet number 2, we're being told that debtor X Gene returned unwanted goods. Then credit note of 5,000 was issued and no entry was made in the books of the business, meaning that in our accounting books we did not record this one. So each time a debtor returns unwanted goods and we don't record it, then obviously sales will decrease, cost of sales will increase, then cost of sales will decrease, then trading stock will increase. Then what about debtors control? Debtors control will decrease. So 3 things are decreasing while one thing is increasing. Cost of sales is decreasing, sales is decreasing, debtors control is decreasing, but trading stock is increasing because the stock is coming back into the business. Okay, then we are being told that the records of the business reveal that total trade discount of 300,000 was allowed on some invoices issued for the year. So we have to know how we can apply the trade discount that is issued. It's simple, this one. It's simple, the trade discount that were offered. Then we also have adjustment on the rent income. We're being told that the rent income include rent for January. Remember, the year is ending on 31st of December Now any income that is received that is after the financial year, that is after the end of the, then it will form part of the income received in advance. And earlier on I showed you that income received in advance, we are going to subtract it. So we are not going to move around not knowing what we are going to do. We are going to subtract it simply because it does not form part of the incomes for that particular year. Then we are being told that the rent has been increased by 1,000 per month from the 1st of September. So we still have to go through this one as well. Then we are being told that 2,000 received from a debtor who was previously written off was not recorded. So it means that we received 2,000 from someone whom we wrote off in the past. So now it means that since we are receiving cash, they're going to be treated as bad debts recovered. Then there's bullet. We're being told that the records showed that a debtor with a balance of 1,200, only 40 cents on the rent must be written off, while the remaining was received and recorded, meaning that here from the 1,200, only 40 cents of that will be treated as bad debts. Remember, each time we write off a debtor, bad debts increase, it does not decrease. Okay, then we are being told that provision for bad debts must be decreased by. Remember what I said, that if they tell you that it is by, just take the amount, do not try to calculate. By is the difference between the one from the previous year and the one from the current year. Then I said if it is a decrease, it is an income. If it is an increase, it is an expense. Increase, expense. Decrease, income. Okay, then we're being told that the physical stock taking on trading stock revealed the following on hand. We are having the one that was purchased on 20 December, 100 units at 1,500 per unit. Total units is 150,000. Then the one that was purchased on the 31st of December, 60 units at 1,100 each. Then total it's 66,000. Then we're being told that the one that is available on hand, it was 93 units, but then we don't know the value of the stock on hand. Remember, we want to find the trading stock on hand, which will be the one that we're going to use to calculate what? To calculate the trading stock deficit. Someone asked earlier on how we're going to calculate trading stock deficit. So I'm going to show you how we calculate trading stock deficit. Okay, remember the business is using FIFO method. So we have to use the FIFO method to find the value of the closing stock on hand. Okay, then the next bullet, we are being told that water and electricity account for December 2023 has been received but not yet paid. Remember the notes earlier on, received but not yet paid. How are we going to treat it? If it is received but not yet paid, remember, if it is received but not yet paid, received but not yet paid, so it is an expense not yet paid. So this one we're going to add it. So it is an accrued expense. An accrued expense, we add them. They form part of the expenses for that particular year. So this one of water and electricity, we're going to add it. Then we're being told that 100% of the consumable stores purchased during the year was utilized, meaning that all the consumable stores that were purchased for that particular year were used. So that will form part of the operating expenses. We are not going to adjust it. Then here we're being told that insurance was paid for the period January 2023 up until February 2024. And remember, our year is ending on 31st of December 2023, meaning that January 2023 and January 2024 do not form part of the financial year. This is an income received in advance, and income received in advance, it's insurance. This is a prepaid expense, and prepaid expense, we subtract them. Sorry for saying income received in advance, just that earlier on we saw the one of income received in advance. Okay, then we are being told that the insurance contract indicated that insurance increased by 10% per annum on November per annum on the 1st of November. It increased by the, meaning that each year it increased by 10%, meaning that the one that will be paying in November will be different from the one that we are paying in October. Okay, then we are also being told that the company had 3 directors. Remember earlier on I said that first identify the number of directors. So first of all, we currently have 3 directors, meaning that we're going to have director A, B, C already. Then we are being told that when the year started, there was 3 directors, and during the year 2 additional directors were appointed on 30 November 2023, and their December fees are still outstanding, meaning that the fees that are currently appearing there are for the 3 directors. So 3 directors, each one of them they worked for 12 months, meaning that we're going to say director A 12 months, director B 12 months, director C 12 months. Then we can use that to find what the outstanding directors fees. Okay, then we are being told that depreciation must be accounted for as follows. On vehicle, it's 15% per annum on cost. Then we're being told that on equipment, at 20% per annum on the diminishing balance method. Then we were being told that note that an old vehicle had a cost of 280,000 and an accumulated depreciation of 255,000 on the 1st of January 2023. So if you see something here, you can notice that already the depreciation that will be calculating might be greater than or the same as the carrying value of this old vehicle. Okay, then we're given information that relates to loan statement. We're being told that the loan statement from Star Bank showed the following. So the balance at the beginning, the 1st of January 2023, is 450,000. Then the interest on loan is capitalized, then it's question mark. Then we're being told that the repayment including interest, it's 80,000. Then we're being told that the balance on the 1st of December 2023, it's 400,000. Now if you notice something, the closing balance from the loan statement, it's way different from the balance from the trial balance. Something is happening here. Yes, it is recording the Masalelo. Don't stress about it. It's also load shedding on my side, so don't stress about it. Okay, then we are being told that interest is capitalized and all the repayments have been made and recorded. Okay, then we are being told that income tax for the year is calculated at 28%. Then we know that we're going to use the net profit before tax. Then now we went through the information, we can actually start answering the question. We went through the information, we can now start answering the question, whereby we are asked to prepare the statement of comprehensive income. So what is the name of the business first? So the name of the business, first of all, let me use a black ink. Okay, so first of all, the name of the business, it's what? It's Shanks Ltd. So here we're going to say Shanks Ltd. Shanks Ltd. Okay, then we're going to say statement of comprehensive income. Statement of comprehensive income. For the year ended for the year ended 31 December 2023. Okay, so let me just put a line here. Okay, so remember we said that we are going to start with sales, so it means that we are going to say sales. Now the first step, we are going to refer to those steps. Remember, the first step will be to open the bracket. Then the second step will be for you to plug the amount. Now the question is, how much are you going to plug, how much are you going to record. We're going to refer to the pre-adjustment trial balance under the nominal account section or the statement of comprehensive income section. Then we're going to look at the sales amount here, which is 4,500,000. Then we're going to plug 4,500,000. Okay, then after you have done this, we're going to look at the debtors allowances here. Then we're going to subtract debtors allowances. So we're going to subtract debtors allowances of 10,000 rands. Okay, then the third step will be for us to check if there is any adjustment that affects sales. We have adjustment, the first adjustment. Remember, we are being told that credit sales of 50,000 were made to debtor L Lufuno, and this was not recorded. Remember what I said, that if a credit sales has occurred or an invoice was issued, then this was not recorded. Then it means sales will increase, cost of sales will increase, trading stock will decrease, debtors control will increase. So here we're going to say plus what? We're going to say sales will increase by the 50,000. Remember, our sales can be cash sales or credit sales. So in our case, it's credit sales. It means we sold on credit. So we're going to add 50,000. But it doesn't end there. Remember, there is also another adjustment. Remember, we went through the information before starting writing. We're being told that debtor X Gene, say what happens if there is a trade discount and the cost of sales is not given, but sales. Don't worry, I'm going to show you how we're going to do it. That's why I gave you the task. I know you are curious, so don't stress. So for this one, we're going to say debtor X Gene returned unwanted goods. Then the credit note of 5,000 was issued. Then no entry was made in the books of the business. So in most cases, they will either bring adjustment like this one or like this one. They just bring one. So now I decided to bring both of them so that I can make you guys to feel more challenged. So this one, since it was a return, then we have to subtract 5,000. So now we want to find the what? The sales. Okay, then we're going to say 1,500,000. Then we are going to subtract the 10,000. Then we're going to add the 50,000. Then we're going to subtract the 5,000. That'll give us a sales figure of how much? Of 4,535,000. 4,535,000. Okay, thereafter we have to record the cost of sales. So cost of sales, we have to find it. So now before we do this one, let me just say cost of sales. Cost of sales. Okay, so let me give you a brief explanation on how this one works. So we know that let's say we know that if we are using a markup, let's assume that our markup it's 60%. Then when our markup is 60%, then let's assume that we want to find the following. We want to find the net sales. We want to find the net sales. Then we also want to find the original sales. Original sales. Let me just do this. Let me do it this way to show you how it works. So it starts with cost of sales. Cost of sales. Then we apply the markup to find the sales, which is the original sales. Which is the original sales. Then what do we do next? We do what? We subtract the trade discount less trade discount. Then we would find the net sales. So if we are issuing out an invoice or we are selling to a debtor, Then when we sell to a debtor, we give them a trade discount. A trade discount simply means that our customers would be buying in bulk, and when they buy in bulk, we grant them trade discount, meaning that the amount, if maybe our, let's say our cost of sales is currently 1,000, then we want to find the sales. When we apply the markup, we're going to say 1,000, then we're going to say multiply by 100 plus what? Plus the markup. Remember the formula, so it will be 160, then we divide by 100, then that gives us how much? That gives us 1,600. So this is the original sales. Then now we grant our customer a 10% discount, trade discount. Now to find the 10% trade discount, we're going to say 1,600, then we subtract the 10%, multiply by 10%, then it gives us 160. Then that will be what? That will be when we take this amount of the original sales of 1,600, we subtract the 160, that gives us net sales of 1,440. Now when we issue out, this is the amount that would appear on the invoice along with the trade discount that was offered. So these two amounts would appear on the invoice. But then the question is, how much will our debtor pay us? When our debtor pay us, or the amount that we are going to consider as the final sales amount, will be this one of net sales. So using this equation, or using this information, we can use the 1,440 to find what? To find the cost of sales. Let's assume that we don't have the 1,000. So we only have the 1,440 and that one of the discount. So let's assume that we have the 1,440, which is the net sales. Then what we are going to do, we know that here we initially subtracted the 160, which is the trade discount. We want this amount here, then we also want this amount here. So what we are going to do, we are going to add back the 160 for the trade discount that was offered. So we are going to say 1,440, we add back the 160, so that we can find the what? We can find the sales, or the original sales amount. Then that gives us 1,600. Now after finding the 1,600, which is the original sales, we're going to use the original sales to calculate the cost of sales, because the cost of sales was used to calculate the original sales. So now we're going to apply the markup, meaning that we're going to take this amount here, then we're going to say to find sales, it will be, to find cost of sales, it will be 1,600, we multiply by what? By 100 over the 100 plus the markup, so it will be 160. So when we take the 1,600, we multiply by 100 over 160, that gives us the 1,000. So Sylvanus Khodimzami asked, what happens if there is a trade discount and cost of sales is not given but sales is given? So now I hope you can see that this is how we do it. Then let's apply in our context here. Now, as I was saying, the amount that we find here is the net sales. If there was any trade discount that was granted to customers or our debtors, then to find the original sales, we have to add back the trade discount. So if you come across information that says trade discount was granted, then you add it back to find cost of sales. When we find sales, what do? We subtract, we find the original sales, then we subtract the trade discount to find the net sales. It is the opposite. Here we want to find the cost of sales. We're going to take the net sales, we add the discount. Let me show the formula. Hopefully you are not going to forget it. If sales is question mark, what you are going to do, you take cost of sales, cost of sales, you add trade discount, then you apply markup. You multiply by 100 plus the markup, then you divide by 100. But now if cost of sales is question mark, this is in the context of trade discount, then you take your net sales, the one that you've just adjusted, net sales, or let me say adjusted sales, I will explain the one from there. You take the if cost of sales is question mark, I'm not doing the opposite here. So you take the net sales, then you add the trade discount. I want to correct the one above. Then you are going to find what? You are going to find the what? You are going to find the original sales. Then what you do, you multiply by 100 over 100 plus the markup. Let me correct this one from above. So here what we are going to do, if sales is question mark, you take cost of sales, you multiply by 100 plus the markup, then you divide by the 100, then that'll give you what? That'll give you original sales, then you'll subtract trade discount, to find the net sales. I'll do the activities on this one so that you can see how it's applied. Then that's how we do this one. So in our case, to answer your question, Sylvanus, in our case we have our net sales here, we don't have our cost of sales. So we're going to take our net sales of 4,535,000. Then we're going to add back the trade discount that was allowed, which is 300,000. So we're going to add back the 300,000. Then we're going to multiply. Remember, we're given a markup earlier on, so every information that is given to you, it's very important. So we're going to say apply the 60% markup here. So we're going to say multiply by 100 over 100 plus markup, so it will be 160. So let's see how much it gives us. So we're going to say 4,535,000. Then we add back the trade discounts, then that gives us 4,835,000. Then we multiply by 100 over 160. Then that gives us how much? That gives us cost of sales. Remember, it should be in brackets. Cost of sales of 3,021,875. You put it in bracket. Now to find the what? To find the gross profit, the answer is simple. We take sales, we subtract cost of sales. That gives us gross profit. So we're going to say gross profit, it's sales minus cost of sales. So it will be 4,535,000. Then we subtract 3,021,875. Or maybe I did not calculate well. Let's see, 4,535,000 plus 300,000 multiplied by 100 over 160. Okay, it's correct. So now to find the gross profit, we're going to take the sales of 4,535,000. Then we're going to subtract 3,021,875. That gives us how much? That gives us a gross profit of 1,513,125. That's how we do it. I hope you answered there, Sylvanus. Okay, then now to the operating incomes. Operating incomes. Now in our operating incomes here, we're going to start with the rent income. So we're going to say rent income. So remember, the first step will be to open the bracket. Then the second step will be to plug the amount. So how much are we going to plug? We're going to plug 135,000 from our trial balance. So we're going to say 135,000. Then next step will be for us to check if we have any adjustment that affects rent. We have it. Adjustment this one. We're being told that rent income includes rent for January 2024. Remember, our year is ending on 31st of December 2023. Then we're being told that the rent has been increased by 1,000 per month from 1st September, meaning that from 1st September the rent has been increasing by what? By 1,000 per month. So this one, it's in respect of rent income. So for this one, we're going to do a timeline so that we can see how we can apply it. So first of all, the year is starting on the 1st of January 2023. Then the year is ending on 31st of December 2023. Then we're being told that, remember, rent has been received up until January 2024. So we're going to say January 2024. Now if you notice something, January 2024, it's outside our financial year. So it means that from the 1st of September up until January, the monthly rent has been increasing by 1,000 per month. So it means we have to find the number of months of those ones. Can you please, cost of n, could you please explain, because I'm not getting your final answer when calculating. Okay, so maybe I'm the one who is miscalculating here. So in terms of the cost of sales, remember, since we are given the net sales, since we granted discounts, it means that the time we're giving out the invoices there, only the net sales were the amounts that were recorded as part of the sales for that particular period. So what we are going to do is that we are going to take the sales that is here, which is the net sales. Then in order to find the original sales, remember, to calculate the cost of sales, we have to use the original sales. So to find the original sales, we're going to take the net sales, then we're going to add back the trade discounts. And when we add back the trade discounts, we're going to apply what? We're going to find the original sales. Then after that, we can find the cost of sales. So let's calculate again. So it's 4,535,000. Then we add with 300,000, that gives us 435,000. Then we multiply by what? By 100 over 160. That gives us 3,021,875. So you are saying in the first adjustment, that one, like, let me tell you this, that one, since we are using this amount of sales here, so we cannot try to adjust our sales, unless if you want, if you prefer, you can start from scratch. If you want to use the 37,500 and also with what, with the other one for the returns, to find it, you have to adjust the one from the trial balance first. Then after adjusting from the one from the trial balance, then that's when you can just add both sides and decrease. It will depend on which approach you want there. I hope it's clear there. Zamangoves, I hope I answered you there. Okay, so let's resume. But then the issue with that is that it might give you different amounts, but then the fact that you are following the right procedure, different answer will be marked as well. Remember, here you are getting a will mark, ne? So Adam Preston, it will depend whether you want to adjust from that one or the one which is the net one, but then I encourage you that you adjust this one, the one that you've just calculated here, to avoid any confusions. Okay, you are welcome there, Adam. Okay, then let's see. We're on the rent. I was explaining the rent part. So in terms of the rent, it means that from the 1st September up until January 2024, rent has been up by 1,000 per month, meaning that, okay, so I understand now. I see where I went wrong. You are welcome. You are welcome. So we're going to say September up until January. So it will be September, October, November, December, and January. So how many months? 1, 2, 3, 4, 5. So we're going to say 1,000 multiplied by 5. Then that gives us 5,000. It means that to find the monthly rent before the increase, so we're going to say monthly rent before increase. We're going to subtract this amount. So we're going to say the trial balance amount, then we subtract the increase. In terms of increment of amounts, not percentages. Then if you remember, the trial balance amount for rent, it was how much? It was 135,000 here. So we're going to say 135,000, then we subtract the 5,000, then that'll give us 130,000. Then we find the monthly rent by taking the 130,000, then we divide it by 13. That'll give us the monthly rent before the increase. So we're going to say 130,000, then we divide it by 13. That gives us 10,000 per month. So to find the monthly rent after increase, then we simply take that monthly rent before the increase, then we add the increase amount of 1,000, then that gives us 11,000. So it means the 11,000 is the rent received in advance. So we have to subtract it. It does not form part of the financial year. So we're going to subtract 11,000 here. So it will be 135,000. We subtract 11,000. That gives us 124,000. Okay. Then the next income will be the bad debts recovered. Remember, line by line. So we're going to say bad debts recovered. Then we're going to open the bracket. Then we're going to plug the amount from the trial balance, which is 12,000. Then next up, we're going to check if there is any adjustment. Now if you remember, there was an adjustment, okay, this one, we're being told that 2,000 was received from a debtor who was previously written off, and this was not recorded. So it means here we are just going to say plus 2,000. We are not going to beat around the bush here. So it means it will be 12,000 plus 2,000, then that'll give us how much? So it will be 12,000 plus 2,000, that gives us 14,000. Okay, then next up will be what? Which income are we going to record next? We don't have any, so here we have to check for additional information again. Okay, we're being told that provision for bad debts must be decreased by. I told you that if they're saying it's by, just bring it to the income side. If decrease by, bring it to the income side. Then if it increase by, bring it to the expense side. So this one, it is a decrease by, it is an income. So we're going to say provision for bad debts, provision for bad debts adjusted. Then it's how much we're going to record, the whole 1,500. Then we're going to say 1,500. So here we don't have any loss that was made from the sale of a fixed asset or any trading stock surplus. Let me not spoil for you. So what we're going to do, we're going to find the total operating incomes. So we're going to add them together. So it will be how much? It will be 1,500 plus 14,000, I mean, plus 124,000. Then that gives us 139,500. 139,500. So now we can find the gross operating income. Gross operating income. Now to find the gross operating income, we take the gross profit, then we add it with the operating incomes. So it will be how much? It will be 1,513,125. We add it with 139,500. So it gives us how much? 1,513,125. Then we add with 139,500. That gives us how much? That gives us 1,652,625. Then we now do the operating expenses. Operating expenses. Okay, so under operating expenses, simple, straightforward. Here we only want the operating expenses. Those ones that are not operating expenses, we do not do them. So here we only want the operating expenses. So we're going to start from the consumable stores. So we're going to say consumable stores. Consumable stores. Remember the first step, open the bracket. Second step, plug the amount. So here we're going to plug 26,000. Then the third step, to check if there is any adjustment that affects consumable stores. So we have adjustment for consumable stores here. They are saying 100% of the consumable stores purchased during the year was utilized. It means that the consumable stores that was purchased is the one that was used for the year. They used all of it. Nothing was remaining. So it will be 26,000. Okay. Then next expense, it will be directors fees. So we're going to say directors fees. Directors fees. So the first step is to open the bracket. Then the second step will be to plug the amount. So here we're going to plug how much? We're going to plug 720,000. This one here. Okay, then to our calculations side. So we're going to say directors fees. Okay, remember earlier on I said that you first have to identify the number of directors that you have in your company. So we're going to refer to information of directors. Okay, so remember the company has how many directors? We're being told that the company had 3 directors when they started. So it means that we already have director A, B, C. Then we're being told that out of those 3 directors, 2 additional directors were appointed on 30 November 2023, the last day of a month. When we pay them, we're going to pay them for December, not for November. Then their December fees are still outstanding. Okay, then it means that we're going to have director D and director E. Okay, so director A, they worked for how many months? For 12 months. Director B worked for how many months? 12 months. Director C worked for how many months? 12 months. Now these 3 directors were paid, while the remaining ones were not paid. So now we want to find the total months that they were paid for. So it will be how many months combined? So it will be 12 multiplied by 3. That gives us 36 months. So now what we want to find? We want to find the monthly directors fees. Monthly directors fees. So to find the monthly directors fees, we're going to refer to the total directors fees that were paid. 720,000. So we're going to say 720,000. Then we're going to subdivide it by 36 months. That'll give us the amount of money that we pay each director per month. So it will be 720,000. Then we divide by 36. That gives us 20,000. It means that each director we're paying him 20,000 per month. Now remember, 2 directors, they worked, but then they were never paid. It means that their December directors fees are outstanding. So to find the one for 2 directors, we're going to say 20,000. We're going to multiply that by 2. It gives us 40. Now remember, if an expense is outstanding, it means it is owed. So we have to add it. So we're going to come here and add the 40,000. Then that will give us the total directors fees for the year. So it will be 720,000. Then we add 40,000. That gives us 760,000. I hope it's clear, this one. Okay, then next one, it will be the audit fees. Then we're going to say audit fees. Now the first step will be to open the bracket. The second step will be to plug the amount. So we're going to record 80,000 here. So we're going to plug 80,000. Then the next step will be for us to check. Now since we went through the information, we don't have any audit fees that are due, so we're going to take it raw as it is. So it will be how much? It will be 80,000. Okay, then the next expense will be advertising. which is 65,000. So here we're going to say advertising. The first step will be to open the bracket. The second step will be to plug in the amount. So how much are we going to plug? We are going to plug 65,000. Then the third step will be for us to check if there is any adjustment. So we're going to check if there is any adjustment that affects advertising. Do we have such adjustment? Let's see. We don't have the adjustment, so we're going to take it raw as it is. So we're going to say advertising 65,000. Okay, then the next expense will be water and electricity. Currently it's 60,000, so we're going to say water and electricity. Then the first step will be to open the bracket. Then the second step will be to plug the amount. So how much are we going to plug? We are going to plug 60,000. So we're going to say 60,000. Then the next step will be for us to check if there is any adjustment that affects water and electricity. Yes, we are being told that water and electricity account for December 2023 has been received but not yet paid. Any expense that was incurred but never paid, it is an accrued expense, so we have to add it here. Add 13,000. Okay, then when we take 60,000, we add it with 13,000. That gives us 73,000. Okay, then the next expense, it's insurance, 28,800. So we're going to say insurance. First step, open the bracket. Second step, plug the amount from the trial balance. So we're going to plug 28,800. The third step will be for us to check if there is any adjustment that affects insurance. We have it here. They are saying insurance was paid for the period January 2023 to February 2024. It means that insurance, it was paid for many months, for 14 months. Now any expense that is outside the financial year that is paid, it will be prepaid expense, therefore we have to subtract it. So here we're going to say insurance. Now if you have the rent formula, that is the solve for X method, you can use it to find the insurance amount. So here I always try to rely on the trial balance. Okay, someone is saying, why didn't you subtract the... Oh, we don't subtract because it was already subtracted. So you don't subtract what was initially subtracted. So we add it back, the 300,000. I hope it's clear there, Mkize. Okay, so here the year it started on the 1st of January 2023. Then it ended on the 1st of December 2023. Then we are being told that it has been paid up until when? It has been paid up until February 2024. Now if you notice something here, why is it added back to the cost of sales? We are adding it back because we want to find the original sales so that we can use the original sales to calculate the cost of sales. Remember, cost of sales is used to calculate the original sales. Thereafter, finding the original sales, we decrease the original sales by the trade discount to find the net sales. So the one that we've adjusted before, the one of 4 million something there, that is the what? That is the net sales. So we add it back so that we can find the original sales before the discount. Then after that, we use the original sales to find the cost of sales, since cost of sales was used to find the original sales. I hope it's clear there. Then we're going to say timeline. Then if you notice something, our year is ending here, so anything that is outside the financial year, it has to be subtracted. So we are being told that insurance, the monthly contract, we are being told that it increases by 10% per annum on the 1st of November each year, meaning that from the 1st of November we are to have an increase of 10%, meaning that after this month the monthly insurance premiums will be 110%, then 110% for January, then 110% for February. So now it means that other remaining months, which will be from January up until October, it will be 10 months. So from January, February, March, April, May, June, July, August, September, October, it's 10 months. So it means that 10 months, which is the one before the increase, multiply by how many percent? By 100%. That gives us 1000%. Then after the increase, then it means that each month it will be how many percent? It will be 110% per month, meaning that from November up until February, the monthly insurance is 110% more than the original one, which is 100%. So it will be how many months? 4 multiplied by 110%. That gives us how much? That gives us 440. So now we have to add the two to find what? To find the insurance amount that is for the months that do not belong in the financial year. So here we're going to add the two, so it will be the 1000 plus the 440. So here, remember, only 2 months are outside the year, so when we add those 2 months, it will be 110 plus 110. That is for the prepaid. Then we are to multiply by the amount on the trial balance. So which is how much? The amount on the trial balance, it's 28,800. So we're going to say 28,800. Then we multiply by how much? By 220. So it will be 28,800 multiplied by 220 over 1,440. That'll give us the what? The monthly the insurance premium for the 2 months that are not for the financial year. So we're going to say 28,800 multiplied by 220 divided by 1,440. That gives us 4,400. It means that 4,400 do not form part of what? Do not form part of the financial year, since these are the premiums for the next financial year. So we're going to come here and say insurance, we subtract 4,400. Okay, so 28,800 subtract 4,400, that gives us 24,400. That's how we do it. That's how we do it. So I see someone is saying, okay, I think I understand a little bit, but why is the sales amount and not 5,2? Okay, let's see. Maybe I didn't calculate well here. Okay, let's see. To answer, you are saying not 5,235. Let's recalculate here. 4,500,000, ne? Then we subtract the 10,000, then we add the 50,000. Okay, then again we subtract the 5,000, then that gives us a 4,500,000, and 35,000, which is this one. So I don't know what's wrong with yours. Maybe it's because you made some errors with the zeros. Try to look, revise your zeros and check if there is no mistake there. I hope you can hear me. Revise your zeros, then check if there is no mistakes there. That is how I calculated it, Mkhize. Okay, let me confirm something here. 28,800 multiplied by 220 over 1,440. It says 4,400. Let's find the monthly one. 28,800 multiplied by 110 over November, December, January, February, over 1,440. It's 2,200. Then 2,200, we minus what? We multiply by 2, meaning that each month. Okay. I hope you are covered there, Mkhize. I hope you are covered there, Mkhize. Okay, then for insurance, I think we handled it very well. Okay, then let's now look at another expense, bank charges. So we're going to say bank charges. Then the first step will be to open the bracket. Then the second step will be to plug the amount. So when we plug, we're going to plug the 3,771. So we're going to say 3,771. Then we're going to check if we have any adjustment that affects bank charges. So based on this information, we don't have it, né? So it will be 3,771. Okay. Oh, November. Okay, then now to the next expense, bad debts. So we're going to say bad debts. Okay, thank you there, Kizwani. Then we're going to say bad debts. The first step will be to open the bracket. Then we're going to say 2,500. Then the next step will be for us to refer to the adjustments. Now if we check adjustments here, we have an adjustment that affects bad debts. So remember this adjustment. We're told that the records showed that a debtor with a balance of 1,200 then had a balance of 1,200, but then only the 40 cents on the rent, meaning that from the amount that was owed, the only 40 cents for every rent should be written off, while the remaining was received and recovered, meaning that bad debts will be that amount multiplied by 40 cents. So we're going to say bad debts. So for bad debts, we're going to say 1,200, then we're going to multiply that by 0.40. That'll give us how much? So 1200 multiplied by 0.40, that gives us 408. It means 408 is the bad debt. So we're going to come here and add the 408 plus 408. So 2500, then we add the 408. That gives us 2908, I mean. Okay, then the next expense will be what? The next expense, I think we have to start with the trading stock deficit. Trading stock deficit. Now for trading stock deficit, we're going to open the bracket. Then here we're going to start by plugging the amount from the trial balance, which is how much? 160,000. So we're going to say 160,000. Then next up, we're going to refer to the cost price of those goods that were sold and returned. So remember, each time there is a sale, then obviously trading stock will decrease. So we're going to subtract how much? We're going to subtract 37,500. We subtract the cost price here. Then we're also going to add the cost price of the goods that were returned. So since we don't know it, it will be the 5,000. Then we're going to multiply that by 100 over 160. That'll give us how much? So 5,000 multiplied by 100 over 160. That gives us 3,125. So we're going to say plus 3,125. Then we have to subtract the value of the closing stock on hand. So for the value of the closing stock on hand, we're going to refer to this information. Remember, they are using FIFO. So to find the value of the closing stock, value of closing stock on hand, value of the closing stock on hand, we are going to count from bottom up when we do the FIFO method. So it will be 93 here. Then since from the remaining 93 units, it means that the entire 60 units is remaining from that. So it will be 60 units. Then we multiply by 1,100. That gives us 66,000. Then to find the remaining, it means we are going to say 93. Then we minus 60. Then it will be 93 minus 60. That gives us 33. It means 33 of the remaining units were from the December purchases, 20 December purchases. Then they were each purchased for 1,500. Then that gives us how much? So we say 33,000 multiplied by 1,500. That gives us 49,500. Then when we add these two together, 49,500 plus 66,000, that gives us 115,500. So this is the what? This is the value of the closing stock on hand. So we're going to come here and say subtract 115,500. Okay, then that'll give us the trading stock deficit. So it will be 160,000 minus 37,500 plus 3,125. Then we subtract the 115,500. Then that gives us how much? That gives us 10,125. 10,125. Okay, then the next one, it will be the last expense, which is depreciation. So for depreciation, that is where we are going to see some things there happening. So I'm going to say depreciation. So I'm going to start with the depreciation for vehicles. Now remember, earlier on I said, when will the 1 rand rule apply? The 1 rand rule will apply when the calculated depreciation is greater than or the same as the carrying value at the beginning of the year. So now in terms of the vehicle, we're going to refer to information here, not forgetting the cost at the beginning. So we are told that the cost here, it's 720,000. From the trial balance, it's 720,000. Okay, then we are also being told that depreciation must be accounted for as follows. Then on vehicle, it's 15% per annum on the cost. Vehicle simply means cost, then it means the formula will be the cost multiplied by the rate. Simple. Okay, then we are also being told that note that an old vehicle had a cost price of 280,000 and the accumulated depreciation was 255,000 on the 1st of January 2023. So let's start by calculating the depreciation of that particular old vehicle. So we're going to say 280,000. Then we're going to multiply it by 15 over 100. That gives us how much? So when we say 280,000, then we subtract 50. We will multiply. We multiply by 15 over 100. That gives us 42,000. Okay. So now let's test it. Let's test. When we test, we're going to say cost at the beginning. Then we say accumulated depreciation at the beginning. We less this one. Then we're going to get carrying value at the beginning. So we're testing so that we can compare. So the cost, it's how much? Is 280,000. Then the accumulated depreciation at the beginning, it's how much? Remember, 255. So it's 255,000. Then to find the carrying value, we are going to say 280,000. Then we're going to subtract 255,000. That gives us 25,000. Now if you notice something here, the one that we calculated is greater than carrying value of 25,000. So when it's like this, it means that the actual depreciation will be how much? The actual depreciation will be this carrying value here. So we're going to say 25,000. Then we're going to subtract the 1 rand of the residual value. So it will be 25,000 minus 1 rand. That gives us 24,999. I hope now you see how we apply the 1 rand rule. Okay, then now to calculate the one that did not exceed its useful life. So if you check there, the amount was 720. So now we want to find the one that was that did not exceed its useful life. So we're going to say 720. Then we're going to subtract how much? We're going to subtract 280. Then that gives us how much? So vehicle 1, this is vehicle 2. So we're going to say 720,000. Then we minus 28,000. 280,000. Then that gives us 440,000. Then we take the 440,000. Then we multiply that by 15%. that gives us how much? So 440,000 minus by 15%, that gives us 66,000. Okay, then to calculate the one for equipment, for equipment it's simple. We're being told that they are using the diminishing balance method. Diminishing balance method simply means cost at the beginning minus accumulated depreciation at the beginning. So it will be how much? So the cost at the beginning, it was 350,000. So we're going to say 350,000. Then we subtract the accumulated depreciation of 125. So we subtract 125,000. Then that gives us how much? Then it's 350,000 minus 125,000. Then that gives us 225,000. Then we multiply that by 20%. Multiply by 20%, that gives us 45,000. Okay, then our total depreciation will be, first of all, will be the 24,999 plus the 66,000 plus the 45,000. So this will be our total depreciation for the year. So it will be 24,999 plus 66,000 plus 45,000. That gives us 135,999. So this will be our depreciation expense for the year. So we are done with our operating expenses. So what we can do now is to add them all together so that we can find the final amount for operating expenses. Okay, I hope you are adding on your side. So we're going to start with the 26,000. So it's 26,000 plus 760,000 plus 80,000 plus 65,000 plus 73,000 plus 24,400 plus 3,771 plus 2980 plus 10,125 plus 135,999. Then that gives me, it has to be in brackets, remember, 2,405,275. Then you are going to calculate twice to confirm that number. 26,000 plus 760,000 plus 80,000 plus 65,000 plus 73,000 plus 24,400 plus 3,771 plus 2,980 plus 10,125 plus 135,999. So it's giving me different number now. So let me just write it on top here. I don't know what I missed before. 81 275. So I'm going to calculate for the third time just to be sure. 26,000 plus 760,000 plus 80,000 plus 65,000 plus 73,000 plus 24,400 24,400 plus 3,771 plus 10,125 plus 135,999, 178. Different number each time I'm calculating. Why is it like this? Each time I calculate, I get different numbers. So let me just erase them here and recalculate again up until I find the same number. 26,000 plus 760,000 plus 80,000 plus 65,000 plus 73,000 plus 24,400 plus 3,771 plus, I missed something last time, 2,980 plus 10,175 25 plus 135,999. So it's giving me that one of 181. So 1,181,275. So I'll just recalculate for the last time to confirm. 135,999 plus 10,125 plus 2,980 plus 3,771 plus 24,400 plus 73,000 plus 65,000 plus 80,000 plus 760,000 plus 26,000. Yeah, then that is the final amount there. Then to find the operating profit, we're going to say gross operating income, then we're going to subtract the operating expense. So it will be 1,652,625. We subtract 1,181,275. Then it will be 1,652,625. Then we subtract 1,181,275. That gives us 471,350. Okay, and then now we're going to add the interest income. So this one is simple, straightforward. We have interest on fixed deposit here, so it's 25,000 250. Then we're going to get profit before interest expense. Profit before interest expense. Then this one we add them. So we add operating profit 471,350. We add it with 25,250. So it's 471,350 plus 471,350 plus 25,250. That gives us how much? 496,600. Then we are to subtract the interest expense. Now for interest expense, if the loan statement is given, let me show you how you can do it best. If the loan statement is given, there are two methods or three approaches. If the loan statement is given, so step number one, you can use the loan account, which is a T account, whereby you are going to refer back to the loan statement. Remember, loan, it is a liability. It increases on the credit side and it decreases on the debit side. So the balance on January, you are going to say balance brought down. Then you'll write 450,000. Then you'd say interest on loan. Then you put a question mark. This will be your balancing figure. Then you come here and say bank. Under bank, it is your repayments. Now your repayments, it include interest, which is 80,000. Then again you'd come and say balance carried down, which will be the balance at the end of 400,000. Then you'd say 400,000. So the first step will be for you to find the big side first, or the larger side. So based on this, the big side will be the debit side. So if we take the 400,000, we add it with the 80,000. So 400,000 we add with the 80,000. That gives us how much? That gives us 480,000. Then you take the 480,000, you bring it here, 480,000. Then if we take the 480,000, we subtract the 450,000, it will give us how much? It will give us the interest on loan amount of 30,000. Now this means that the interest on loan is 30,000. Then another approach is that you can use the formula whereby you say B balance at end, B end, let me just say B end, balance at end. Then you add repayment, then you subtract B big, balance at the beginning, B back. You see, now based on this, it will be how much? So balance at the end, it is the 400,000. Then the repayment is the 80,000. Then the balance at the beginning is the 450,000. Now it will give you the same answer. So let's see, 400,000 plus the 80,000 of the repayment, subtract the balance at the beginning of it, gives us 30,000. Then approach number 3 is that you compare. It will be balance at end, B end on loan statement, then you subtract the trial balance amount, TBA. So if we check the one on the loan statement, we have the 400,000. Then based on the loan statement, it's how much? On the loan statement it's 400,000, but on the trial balance it's how much? On the trial balance it's 370,000. So this one is just short of the interest, the one on the trial balance, so it will be 370,000. So if we take the 400,000, then we just subtract the 370,000, it gives us the 30,000. Or if you prefer, you can just subtract everything from balance at the beginning. Let me show you another fourth approach. If you prefer the fourth one, you subtract here, so it will be 450,000, subtract 80,000, subtract 400,000. It will give you the same answer. 450,000, subtract 80,000, then we subtract 400,000. It still gives us that. So which other method that you prefer, as long as it gives you the interest on loan, you have to show its calculation. That will be your interest expense for the year. So here we're going to say 400,000, then we add the 80,000, then we subtract the 450,000, then that'll give us the interest on loan, or the interest expense for the year of how much? Of 30,000. It has to be in brackets. Okay, so now when we take, we'll find the profit, net profit before tax. So to find the net profit before tax, we're going to say profit before interest expense, then we subtract the interest expense, so it will be 496,600, then we subtract the 30,000. I'm getting, oh, thank you there, Faye, we got the same amount there, thank you. Then it will be 496,600, then we subtract 30,000, then that gives us how much? 466,600. Then we want to subtract the income tax. Now remember, we calculate the income tax based on the net profit before tax, so we're going to say income tax. So it will be 466,600, then we're going to calculate it by 28%, so it will be 28%. Let's hope it doesn't give us commas here. 466,600 multiplied by 28%. Whew! We were lucky, no commas. So the income tax for the year is 130,648. Then that is the net profit after tax. Net profit after tax. Net profit after tax, we subtract the income tax, so it will be how much? It will be 466,600, then we subtract 130,648. That gives us the net profit after tax of 335,952. That is our statement of comprehensive income, guys. It's very, very, very fun and simple, not complicated. It's very, very fun. Okay, so if guys you have any question, don't be afraid to ask. Okay, so that's how we do it. So I'm just going to wait for some few moments, because I know that the video is late, I think by a minute or 2 or 4 minutes there. So I'll be waiting if maybe you have questions on how we do them and why are we doing this and this. So that's how we do things, guys. If you have any question, you can ask. Okay, then if there is no any question, guys, then we can end here for the night. Then what I'm going to do now, I'll look for 10 activities that are based on the statement of comprehensive income. If you go through all 10 of them, then I assure you, you'll never fail the statement of comprehensive income. So that's it from me for the night. Enjoy. It's morning, it's midnight, so and enjoy your night.